A hostile takeover is like a rival team trying to sign a star player without the current team's consent. The acquirer, the raider, makes a direct offer to the target's shareholders or tries to replace the board, bypassing the management's blessing. Objectives include gaining control of valuable assets, achieving synergies, or removing a competitor. Types: tender offer raid, a public offer to buy shares at a premium, similar to shouting, "Buy my tickets, I'll pay extra." Proxy fight, the acquirer asks shareholders to vote out current directors and install a friendly board, like trying to replace the coach by rallying fans. Creeping acquisition, slowly buying shares on the open market until the acquirer crosses a control threshold, akin to quietly buying most of the neighborhood's houses. Each type differs in speed, cost, and the level of resistance it provokes. Hostile bids are governed by a rulebook that balances free market play with investor protection. In the United States, Securities Exchange Act, SEC Rule 14E1 and 14E2, requires timely disclosure of any offer that could affect the price of a security, much like a referee must announce a penalty right away. Regulation SK forces the target to file detailed information about the offer, ensuring transparency. Antitrust statutes, Sherman and Clayton Acts, stop deals that would create a monopoly. The Department of Justice or Federal Trade Commission can block a takeover that would crush competition, similar to a league preventing one team from owning all the best players. State corporate law, for example Delaware General Corporation Law, gives boards fiduciary leeway to adopt defensive measures, but also mandates they act in shareholders' best interests. Violating these rules can lead to lawsuits, fines, or forced unwinding of the transaction. Valuing a hostile offer is like figuring out how much a house is worth before making a bid. Two major tools are used. Discounted cash flow, DCF. Enterprise value equals the sum from T equals 1 to N of FCF sub T, divided by 1 plus WACC to the T plus TV divided by 1 plus WACC to the N. Where FCF is free cash flow, WACC the weighted average cost of capital, and TV the terminal value. The acquirer adds a premium to this intrinsic value to entice shareholders. Comparable multiples, look at similar companies that sold recently. Common multiples are EV over EBITDA, P over E, and price over book. Example: if peers trade at 8 times EBITDA and the target's EBITDA is 200 million, the baseline value is 1.6 billion. Offer premium calculation. Premium percent equals offer price minus current market price divided by current market price times 100. A typical hostile premium ranges from 20 to 40%, sometimes higher if the target is undervalued or strategically critical. Board members are like trustees of a family estate. They must act loyally and prudently for the benefit of all beneficiaries, shareholders. Their fiduciary duties include: duty of care, make informed decisions, akin to researching a car before buying it. Duty of loyalty, avoid conflicts of interest, like not buying a product from a company you own. When a hostile bid arrives, the board follows a defensive decision-making framework. Assess fairness. Conduct a fairness opinion from an independent investment bank to see if the offer reflects true value. Consider alternatives. Look for better offers, strategic partnerships, or restructuring. Evaluate impact on stakeholders, employees, customers, and long-term growth. Document rationale. Courts will scrutinize the board's process. A well-recorded, data-driven analysis helps defend against lawsuits claiming the board acted imprudently. If the board finds the offer insufficient, it may adopt defenses. See next topic. Traditional defenses are the playbook teams use to keep opponents from scoring. Whitewash or white squire. The target sells a non-controlling stake to a friendly investor who agrees not to support the hostile bid, similar to hiring a security guard who will not open the doors. Staggered classified board. Directors serve multi-year terms with only a fraction up for election each year, making a rapid boardroom takeover difficult, like a sports league where only a few players can be traded each season. Pac-Man defense. The target turns the tables and makes a counter offer to buy the acquirer, akin to a boxer dodging a punch and landing a knockout. Poison pill covered later. a self-destruct mechanism that makes the purchase far more expensive. Crown jewel sale. The target sells its most valuable asset to a third party, depriving the acquirer of the main attraction, like a bank selling its prime loan portfolio before a hostile merger. Each tactic has trade-offs. Aggressive defenses can hurt shareholder value or invite regulatory scrutiny. Explanation: a poison pill is a contract that dilutes an acquirer's ownership once they cross a preset threshold, turning the takeover into a costly poisonous snack. One flip in pill shareholder rights plan: existing shareholders, except the acquirer, receive rights to purchase additional shares at a discount if any one shareholder exceeds, say, 20% ownership. New shares I equals rights I divided by trigger threshold times shares outstanding. 2. Flip over pill: rights allow shareholders to buy the acquirer's shares at a discount after the takeover is completed. If the acquirer succeeds, the target's shareholders can flip their rights into cheap shares of the acquiring company, diluting the acquirer's equity. 3. Preferred stock pill: the company issues preferred stock that automatically converts into common stock at a low price when a trigger event occurs, flooding the market with new shares. Trigger thresholds are usually set between 10 to 30% of outstanding shares and are disclosed in the company's charter. Once breached, the rights become exercisable within a short window, often 30 to 60 days. The discount is typically 50 to 75% of the market price, making the acquisition financially unattractive. These mechanisms are designed to give the board bargaining power or force the bidder to negotiate a higher price. Explanation: to see the numeric effect of a poison pill, analysts model dilution and its impact on earnings per share, EPS, and takeover premium. Assume: shares outstanding equals 100 million. Trigger threshold equals 20%, 20 million shares. Rights issued to remaining shareholders equals 40 million new shares at $10 each, 50% discount to $20 market price. Dilution calculation. Post-pill shares equals 100 million plus 40 million equals 140 million. EPS impact. If net income equals $500 million, pre-pill EPS equals $5. Post-pill EPS equals $500 million divided by 140 million equals $3.57, a 28.6% drop, making the target appear less attractive on a per-share basis. Takeover premium adjustment. The acquirer must now buy 140 million shares at the market price or pay a higher premium. The effective cost per original share rises. Effective cost per original share equals total purchase price divided by original shares. If the acquirer offers $30 per original share, total cost equals $30 times 100 million equals $3 billion. After dilution, they own 100 million divided by 140 million equals 71.4% of the company, effectively paying $3 billion divided by 0.714 equals $4.20 billion for full ownership, a 40% increase over the initial bid. This quantitative illustration shows how a poison pill can dramatically raise the price the acquirer must pay, protecting shareholders, but also potentially depressing share price if investors fear an unresolvable stalemate. Effectiveness of poison pills versus other defenses can be judged by looking at real-world cases. Netflix 2012 versus Starz. Netflix used a flip in pill. Starz's bid was withdrawn after the pill made the deal financially unattractive. The pill was highly effective. Yahoo 2008 versus Microsoft. Yahoo adopted a staggered board and a poison pill. Microsoft eventually raised its offer, but the defenses forced a higher price and gave Yahoo leverage. Still, the prolonged battle hurt Yahoo's stock. Sanofi-Aventis 2004 versus Roan Pooling. Sanofi used a poison pill and a crown jewel sale, selling a valuable drug portfolio. The pill alone was insufficient. The crown jewel sale tipped the balance. Comparative takeaways. Number 1. Poison pills are best when the acquirer seeks a quick, low-cost takeover. They raise the financial hurdle. Number 2. Staggered boards are useful when the acquirer needs board control to approve the deal. They buy time. Number 3. Crown jewel sales work when the target can afford to lose a valuable asset without destroying long-term value. Number 4, combination strategies. Pill plus staggered board often provide the strongest defense, as seen in the Netflix and Yahoo examples. However, overly aggressive defenses can trigger shareholder lawsuits for entrenchment, so boards must balance protection with fiduciary duty. Overall, empirical studies show that firms with poison pills experience lower takeover premiums, average 22% versus 35% for firms without. But they may also see a modest long-run share price underperformance if the pill discourages value-enhancing bids. Explanation. Sample exam questions. 1. Multiple choice. Which of the following best describes a flip over poison pill? Option A. Rights allowing existing shareholders to buy additional shares of the target at a discount. Option B. Rights that let shareholders purchase the acquirer's shares at a discount after a successful takeover. Option C. Preferred stock that converts into common stock when a trigger is met. Option D. A staggered board that limits annual director elections. 2. Short answer. Explain how a staggered board can delay a hostile takeover and discuss one potential downside for shareholders. A staggered board divides directors into classes serving multi-year terms. Only one class is up for election each year, so an acquirer would need several years to replace a majority. Downside: shareholders may be stuck with underperforming directors for longer, reducing accountability. 3. Calculation. Company XYZ has 50 million shares outstanding trading at $40. A hostile bidder offers $55 per share, a 37.5% premium. XYZ has a flip in poison pill that triggers at 20% ownership, issuing 30 million new shares at a 50% discount to market price. Compute the acquirer's effective cost per original share if it proceeds with the offer. A solution. Trigger: 20% of 50 million equals 10 million shares bought by the acquirer. New shares issued: 30 million at $20 each equals $600 million capital raised. Total shares after pill equals 50 million plus 30 million equals 80 million. Total purchase price for original shares equals $55 times 50 million equals $2.75 billion. Effective cost per original share equals $2.75 billion divided by the fraction 50 million over 80 million, which equals $4.40 billion. Effective price per original share equals $4.40 billion divided by 50 million equals $88 per share. Thus, the pill doubles the effective price from $55 to $88. 4. Essay. Discuss the fiduciary duties of a board when faced with a hostile takeover and how those duties influence the choice of defensive tactics. Key points to cover: duty of care, need for thorough valuation and fairness opinion. Duty of loyalty, avoid self-interest, consider all shareholders. Business judgment rule, requirement to document decision-making, and how these duties may justify or limit the use of poison pills, staggered boards, or selling assets. These questions test conceptual understanding, ability to apply formulas, and critical analysis of legal strategic considerations. Sample calculation summary for quick reference. Premium percent equals the offer minus market divided by market times 100. DCF enterprise value equals the sum of free cash flow at time t divided by 1 plus weighted average cost of capital to the power t, plus terminal value divided by 1 plus weighted average cost of capital to the power n. Effective cost after pill equals the offer times original shares divided by the original shares, divided by the sum of original shares and new shares. EPS dilution equals net income divided by the sum of original shares and new shares. From this explanation, you just need to break them into segments, and for each segment return phonetic reading style of the segment.